Hi, I just wanted to give you a preview of the final essential question we had here. This is the income and cash flow statement question, which brings together a lot of what we've been doing in this class in a form which will look like what you'd see in a proposal or in a business plan. First thing is that we'll start off with a rather brief description of an investment problem. Now sometimes it'll be an additional expense, sometimes it'll be that you bought a new asset. But I'll usually describe what this change is supposed to be. In this case, what we did was we purchased a new asset. It's a Thneed. You may remember that from the Lorax. And I'll tell you what the cost basis of the asset is. In this case, it's a $10,000 asset. And I'll also tell you what class it is. And so what we're saying is that this is a 5-year asset for depreciation purposes. I've added a little extra data. Told you that this thing will generate $2,000 worth of additional revenue. And an additional $1,000 worth of operating costs. And then there's always some kind of complication. In this case, what I've done was I said that you're financing this thing with a loan. Typically, if I have a loan and it's more than one of the two attributes that's there, I'll make the loan something relatively simple. In this case, what I've done is I've given you a loan with a single payment in year 2, and that means you don't have to do anything complicated. The calculations are really easy. I've also gone ahead and given you an anticipated date for selling the Thneed, which is in year 2. I've told you what your salvage value is supposed to be, and that should give you a hint that there's going to be a gains tax calculation in here. I also provide you with necessary financial information for your firm, so we're looking at something which has a combined tax rate of 35% and also a minimum acceptable rate of return of 10%. So the numbers of the story are all up there, and I'll try to keep the sentences and descriptions as simple as possible. Remember, anytime during your quiz, just go ahead and ask me for a clarification. I'll go ahead and tell you what's going on. Now, the next piece of data that you'll have on every single one of these is this mid-year modified accelerated cost recovery system table. This is exactly what you should have in your book, and it means that you don't have to refer to another piece of paper in order to do any of the calculations that come after. The last sheet of the paper is where you're going to put your answers. Now, the first question is going to be just to fill in the income and cash flow statement above. And the second question is to decide if this is actually a good investment. Now, filling in the income and cash flow statement, I give you plenty of room, even though this is a 2-year problem that was described above. Some of the problems may extend to 4 years, and I just put all 4 years there no matter what. You can put in your operating revenue changes, your operating expense changes. I think that was the 2,000 and the 1,000 above. Any kinds of interest expense, so there's one that's going to be there for the second year. Depreciation in the 2 periods, something you can easily calculate. And you can work your way down until you end up with the net income in both years. You can then move to the cash flow statement, moving the items from above down to the cash flow statement. Net income is the same as above, depreciation is the same as above. And I've left you some space should you be purchasing an asset for the purchase of the asset where you see this negative number, the sale of the asset where you see a positive number. Maybe it's a problem with working capital changes. This one isn't. It could be that because of the asset purchase that you're going to have increased accounts receivable or increased inventory. That's possible. And I've given you a space here to handle the gains tax. And in this problem, you're going to have some of that because you have to sell the asset, and you're probably going to sell it for something other than its book value. I've also given you some space here to put in information about the loan, say an inflow of cash because you're going to have money coming in because you took out the loan, and then an outflow of cash because you're making a payment. And then finally, you're going to convert that into the net cash flow. The final question is just asking you to decide if this is a good idea. And so the easiest thing you can do in most cases is just take a look at the net cash flows, discount them back to the first year, and if the present worth of that is greater than 0, it's something you should buy. Hopefully this provided you with enough of an introduction to the 4th question to make it through in the first pass.